47 minutes ago, the Pentagon confirmed what satellite imagery and Iranian state media had been reporting for the past 3 hours. A United States Navy submarine has sunk an Iranian naval vessel in the Strait of Hormuz. The USS Florida, an Ohio-class guided missile submarine, fired 2 Tomahawk cruise missiles at the Sahand, an Iranian frigate, after the Sahand allegedly illuminated the submarine with fire control radar. The Sahand sank within 11 minutes. Iranian state television is reporting 127 sailors dead or missing. The Pentagon is calling it a defensive action in response to hostile targeting. Iran's supreme leader has called it an act of war that will not go unanswered. And right now at 2:47 p.m. Eastern on this Friday afternoon, we are 66 hours away from Sunday night's futures open. 66 hours for this situation to escalate, de-escalate, or spiral into something that rewrites the global order. Gold closed the regular session at 2,147. Silver closed at $34.12. But those prices are already stale. They don't reflect what just happened. They don't reflect what's coming. By Monday's 6 p.m. Eastern futures open, those prices will be dramatically different. The only question is how different. Today, I'm going to walk you through the 3 scenarios that could unfold over the next 66 hours, the specific price targets for gold and silver under each scenario, and exactly what I'm doing right now to position for what I believe is the most significant precious metals catalyst since the 2008 financial crisis. The clock is ticking. Let me show you where we're headed. Let me give you the full context because the details of this engagement matter enormously. The USS Florida was transiting the Strait of Hormuz as part of Operation Sentinel, the U.S. naval mission to ensure freedom of navigation in the Persian Gulf. At approximately 11:23 a.m. local time, which is 3:23 a.m. Eastern, the Sahand, an Iranian Mauj-class frigate, began tracking the Florida with fire control radar. Fire control radar is not surveillance radar. It's targeting radar. It's what you use immediately before launching missiles. Under U.S. Navy rules of engagement, being painted by fire control radar constitutes a hostile act that justifies defensive response. The Florida's commander made a decision. At 11:31 a.m. local time, 2 Tomahawk missiles were launched. The Sahand was hit amidships and in the engine room. The ship broke apart and sank by 11:42 a.m. The entire engagement lasted 19 minutes, from first radar contact to the Sahand disappearing beneath the surface. This is the first direct military engagement between U.S. and Iranian naval forces since 1988, when Operation Praying Mantis saw the U.S. Navy sink 2 Iranian frigates and destroy 2 oil platforms after an Iranian mine nearly sank the USS Samuel B. Roberts. That engagement was the largest U.S. surface naval action since World War II. It did not trigger a wider war. Iran backed down. Oil prices spiked 12% and then stabilized. Gold rose 4% over the following 2 weeks. Silver rose 7%. The response was significant but contained. But 1988 was a different world. Iran's military capabilities were limited. Its regional influence was constrained. Its alliance structure was weak. Today, Iran has proxies throughout the Middle East. Hezbollah in Lebanon, the Houthis in Yemen, militias in Iraq and Syria. It has ballistic missiles capable of striking U.S. bases across the region. It has asymmetric warfare capabilities that can disrupt shipping far beyond the Strait of Hormuz. And it has a closer relationship with Russia and China than it did in 1988, creating geopolitical complications that didn't exist then. The potential for escalation is dramatically higher, and the markets know it. Let me show you what's happening right now because the paper markets are closed, but the signals are everywhere. Bitcoin, which trades 24/7 and often acts as a leading indicator for risk sentiment, has spiked from $67,400 to $73,200 since the Pentagon confirmation. That's an 8.6% move in 3 hours. It's not a Bitcoin-specific move. It's a flight to assets outside the traditional financial system. The futures markets for gold and silver don't officially open until Sunday at 6 p.m. Eastern, but there's an informal over-the-counter market where large institutions trade during weekends. I have a contact at a metals trading desk who shared indicative pricing with me 20 minutes ago. Gold is being quoted OTC at $2,920 to $2,160 bid ask. That's $73 to $113 above Friday's close. Silver is being quoted at $36.80 to $37.40. That's $268.8 to $328 above Friday's close, representing a 7.8% to 9.6% premium. These are not firm prices. There's almost no liquidity in weekend OTC markets. But they're indicative of where the large players expect the Sunday open to print. And they're expecting a gap higher, a significant gap higher. The oil market is telling the same story. WTI crude futures closed Friday at $87.32. The OTC indicative pricing I'm seeing is $97 to $102, a $10 to $15 spike from Friday's close. If those prices hold into Monday's regular session, it will be the largest single weekend move in oil since the 2020 COVID crash, but in the opposite direction. Energy costs flowing into mining operations, transportation, and refining will immediately pressure silver supply chains. And the safe haven bid from geopolitical uncertainty will pressure silver demand to the upside. Both forces point the same direction, higher. Now let me walk you through the three scenarios because the next 66 hours will determine which path we take. Scenario 1, diplomatic de-escalation. In this scenario, both sides step back from the brink. The United States expresses regret for the loss of life while maintaining that the Florida acted in self-defense. Iran condemns the attack but stops short of military retaliation. Behind the scenes, intermediaries like Oman, Qatar, or Switzerland facilitate communication. Both governments recognize that escalation serves neither side's interests. Iran cannot win a conventional war with the United States. The United States does not want another Middle Eastern quagmire during an election year. A face-saving formula is found. Iran demands an international investigation. The U.S. agrees to participate in a UN-led inquiry. Both sides agree to maritime deconfliction protocols. The Strait of Hormuz remains open. The immediate crisis passes. In this scenario, here's what happens to prices by Monday's open. Gold gaps higher to $2,190, $2,920 on the Sunday open as initial panic drives safe haven buying. By Monday morning, as de-escalation signals emerge, gold retreats to $2,160, $2,180, still above Friday's close but significantly off the highs. Silver gaps to $35.50, $36 then retreats to $34.80, $35.20. The premium to Friday's close is 2.3% for gold and 2.3% for silver. Significant but not explosive. This scenario preserves the status quo. The underlying structural case for precious metals remains intact, but no new crisis premium is permanently embedded in prices. Probability I assign to this scenario? 25%. Why only 25%? Because the domestic politics in both countries make de-escalation difficult. In the United States, backing down after Iran targeted a U.S. submarine would be portrayed as weakness by political opponents. In Iran, failing to respond after 127 sailors were killed would be seen as capitulation. Both leaderships face pressure to escalate, not de-escalate. The incentive structures are aligned toward conflict, not resolution. Scenario 2, asymmetric Iranian retaliation. In this scenario, Iran retaliates but avoids direct state-to-state military confrontation. They use their proxy network to inflict damage while maintaining plausible deniability. The options are numerous. Hezbollah launches rockets into northern Israel, triggering an Israeli response that draws attention away from the U.S.-Iran dynamic. Houthi forces in Yemen attack Saudi oil facilities or shipping in the Red Sea, disrupting global energy markets without Iran directly pulling the trigger. Iranian-backed militias in Iraq launch drone or rocket attacks on U.S. bases, causing casualties but staying below the threshold that would trigger massive U.S. retaliation. Cyber attacks target U.S. financial infrastructure, power grids, or water systems. The attacks are damaging but calibrated. They inflict pain without triggering full-scale war. Iran demonstrates that it can hurt the United States and its allies without presenting targets for conventional military response. In this scenario, here's what happens to prices. The Sunday open gaps dramatically higher as markets price in sustained regional instability. Gold opens at $2,940, $2,980. By Monday morning, as the scope of Iranian retaliation becomes clear, gold pushes to $3,000, $3,050. The psychological $3,000 level breaks for the first time in history. Silver opens at $36.50, $37.50, and pushes to $38 or $40 by Monday morning as both safe haven demand and supply disruption concerns accelerate. The premium to Friday's close is 7 to 12% for gold and 11-17% for silver. Silver outperforms gold because it has both the monetary safe haven component and the industrial supply disruption component. This scenario embeds a permanent crisis premium into precious metals. Even if the immediate retaliation fades, the market will price in elevated risk of future escalation for months or years. Probability I assign to this scenario, 55%. This is my base case because it fits the pattern of Iranian behavior over the past 2 decades. Iran has consistently chosen asymmetric responses to U.S. pressure. They didn't directly attack U.S. forces after Soleimani's assassination. They launched missiles at Iraqi bases with advance warning to minimize casualties. They didn't block Hormuz after sanctions were reimposed. They attacked tankers with mines and drones to create uncertainty without outright closure. They calibrate carefully. They escalate enough to demonstrate capability and resolve, but not enough to trigger regime-threatening U.S. military response. I expect the same playbook here. Proxies will strike. The region will destabilize, but Iran will avoid the direct confrontation they cannot win. Scenario 3. Direct military escalation. In this scenario, Iran abandons its traditional calibration. The death of 127 sailors, broadcast continuously on Iranian state media, creates domestic pressure that the regime cannot manage with proxy responses alone. The Revolutionary Guard, which has significant autonomy from civilian leadership, launches direct military action. Ballistic missiles strike U.S. bases in Qatar, Bahrain, or the UAE. Anti-ship missiles sink a U.S. destroyer or damage an aircraft carrier. The Strait of Hormuz is mined and closed to all traffic. Simultaneously, Hezbollah launches a massive rocket barrage into Israel, opening a second front. The Houthis close the Red Sea with anti-ship missile attacks. The entire Middle Eastern energy infrastructure comes under threat. The United States responds with overwhelming force, strikes on Iranian military installations, nuclear facilities, and leadership targets. Iran's navy is destroyed within 48 hours. Iran's air force is destroyed within 72 hours. But the asymmetric capabilities remain. The mines are in the water. The missiles are dispersed and hidden. The proxy forces are activated across the region. Oil exports from the Persian Gulf halt entirely. 21% of global oil supply disappears from the market. The global economy enters immediate crisis. In this scenario, here's what happens to prices. Gold doesn't gap higher. Gold explodes higher. The Sunday open prints $3,100, $3,200, up $250, $350 from Friday's close in a single weekend. By Monday morning, as the scale of the conflict becomes clear, gold trades $3,300, $3,500, a 15-23% move in 3 days. Silver undergoes a similar explosion, but with greater magnitude due to its smaller market size and dual industrial monetary demand. The Sunday open prints $42, $45. By Monday morning, silver trades $48, $55, a 40-60% move in 3 days. These are not predictions I make lightly. These are the mathematical consequences of a war that removes 21% of global oil supply and threatens the entire Middle Eastern energy infrastructure. The precedent is 1979-1980, when the Iranian Revolution and Soviet invasion of Afghanistan created a similar confluence of energy and geopolitical crisis. Gold went from $200 to $850 in 18 months. Silver went from $6 to $50. The same magnitude of move, compressed into a shorter time frame by modern market speed, gives you $3,500 gold and $55 silver as reasonable targets for an all-out war scenario. Probability I assign to this scenario? 20%. Why 20%? Because Iran knows it cannot win a direct war with the United States. Their military would be devastated within weeks. The regime itself would be at risk. Even the Revolutionary Guard, for all their ideological fervor, understand the correlation of forces. They will want to retaliate in ways that hurt the US without triggering their own destruction. But here's the risk: miscalculation. In the fog of crisis, with emotions running high and incomplete information flowing, decisions get made that wouldn't be made in calm conditions. A Revolutionary Guard commander launches missiles without authorization. A U.S. pilot misidentifies a target. An Iranian submarine attempts to attack a carrier and gets detected, triggering a broader engagement. Wars often start not from deliberate choice, but from escalation spirals that no one controls. I assign 20% probability to this scenario, not because I think Iran will choose it, but because I think the chaos of the moment creates a 1 in 5 chance that someone, somewhere, makes a decision that tips us into it. Now let me show you the expected value calculation, because this is how I'm thinking about positioning. Expected value is probability times outcome. For gold, if I assign 25% probability to scenario 1, gold at 2,170, 55% probability to scenario 2, gold at 3,025, and 20% probability to scenario 3, gold at 3,400. The expected value is 0.25x 2,870 plus 0.55x 3,025 plus 0.20x 3,400, or 717,50 plus 1,663.75 on 680, 3,061.25. The expected value of gold by Monday's open is $3,061, which is $2,420 or 7.5% above Friday's close. For silver, using the same framework, scenario 1 at 35 Q, scenario 2 at $39, scenario 3 at $52. Expected value, 0.25x $35 plus 0.55x $39 plus 0.20x $52. 8x75 plus 2145 plus 1040 in 4060. The expected value of silver by Monday's open is 4060, which is 648 or 19% above Friday's close. These expected values suggest silver significantly outperforms gold in all scenarios. The asymmetry in silver is greater. The downside in scenario 1 is limited, perhaps 34-35ers. The upside in scenario 3 is explosive, perhaps $50-$55. The risk-reward profile favors silver over gold in this specific crisis. Let me show you what I'm doing right now, because I believe in transparency about my actions during crisis moments. Within 30 minutes of the Pentagon confirmation, I began making calls. First, I called my primary dealer. They're on the East Coast. It was 2:15 p.m. on a Friday. They picked up on the fourth ring. The representative told me they had already received 47 orders since the news broke. Premiums were being revised upward in real time. Generic rounds that were $3 over spot at Friday's close were being requoted at $5 over spot. Eagles that were $8 over were being quoted at $12 over. I placed an order for 200 generic rounds at the revised premium, locking in $39.12 per ounce effective cost against the $34.12 Friday close spot. If silver opens at $40 on Sunday night, I'll have effectively bought at a discount to the new reality. If silver somehow returns to $34, I've overpaid by $5 per ounce. I'm willing to accept that risk given the expected value calculation. Second, I called my backup dealer. They're on the West Coast. They were even more chaotic. The representative said they were considering suspending online orders over the weekend because they couldn't keep pricing accurate. She quoted me 100-ounce bars at $2 over spot, but warned that the quote was only good for 10 minutes before they'd need to reevaluate. I ordered 2 100-ounce bars, committing $7,224 at $36.12 per ounce effective cost. Combined with my earlier order, I've deployed $15,048 in the past 2 hours. This represents approximately 40% of my remaining precious metals cash allocation. Third, I've placed limit orders for Monday's stock market open on my mining positions. I expect the miners to gap higher, but there may be opportunities if the initial spike creates selling from profit takers. I've placed limit orders on First Majestic at $6.20, Hecla at $7.80, and Pan American at $24.50. These are approximately 15% above Friday's close, which would represent a pullback from what I expect to be a 25 to 40% opening gap. If the orders fill, I'll have added leverage to my silver position. If they don't fill, I'll reassess on Monday afternoon. Fourth, I've updated my physical security preparations. This may sound extreme, but a US-Iran war is not a normal event. If Scenario 3 materializes, there will be domestic disruptions, cyber attacks on infrastructure, possible terrorist activity, economic dislocations. I've verified that my stored silver is properly secured. I've confirmed that my documentation is in order. I've topped off fuel in my vehicles. I've ensured that essential supplies are adequate for 2 weeks of disruption. These preparations cost nothing if the crisis de-escalates. They're invaluable if it escalates further. The time to prepare is before you need to, not after. Let me address the people who think I'm overreacting because I know this video will draw that criticism. Some will say, "This is just another Middle East flare-up. It'll blow over. You're being dramatic." I understand that perspective. We've had decades of Middle East tensions that didn't produce World War III. We've become desensitized. We assume that every crisis resolves because every previous crisis resolved. But this is survivorship bias. Every crisis resolves until one doesn't. Every escalation stops until one doesn't. The fact that we haven't had a major war between great powers in 80 years doesn't mean we won't have one. It may mean we're overdue. The historical frequency of great power conflict suggests that multi-decade periods of peace are the exception, not the rule. I'm not predicting war. I'm acknowledging that the probability of war just increased significantly, and I'm positioning accordingly. Let me also address the people who think they've missed the move. Some will say, gold's already up, silver's already up, I should have bought yesterday, it's too late now. It's not too late. If Scenario 2 or 3 materializes, the moves have barely begun. A 7.5% expected move in gold and a 19% expected move in silver by Monday morning is just the opening act. If this crisis extends through next week, gold could reach $3,200, $3,500, and silver could reach $50, $65. If it extends through next month, the targets move dramatically higher. The 1979-1980 crisis took 18 months to fully play out. The moves were not linear. There were pullbacks along the way. Every pullback was a buying opportunity in retrospect. The same will be true here. If you didn't buy yesterday, buy today. If you can't buy today, buy Monday. If Monday is too expensive, buy the first pullback. The worst decision is to do nothing and watch from the sidelines as the crisis unfolds. Let me give you the technical levels to watch because the charts will guide the trading flow. Gold's immediate resistance is the all-time high at 2,180 $. Above that, there's nothing but open air until psychological resistance at $3,000, $3,100, $3,200. Each $100 level will create pause points where profit-taking occurs. But in a genuine geopolitical crisis, psychological levels provide only temporary resistance. The momentum buyers overwhelm the profit takers. Gold support is at $2,800, then $2,750, then $2,700. In Scenario 1, the de-escalation scenario, these support levels will be tested. In Scenarios 2 and 3, support becomes irrelevant because price never returns to test it. Silver's immediate resistance is at $35, then $37.50, then the 2024 high at $38.50, then the 2021 high at $30. Wait, that's not right. Let me recalculate. Silver's 2021 high was approximately $30.35. We're already above that. The 2024 high was $34.87. We closed Friday at $34.12. Immediate resistance is the 2024 high at $34.87, then $35, $37.50, $40, and ultimately the 2011 high at $49.82. If we break $50 in this crisis, silver enters price discovery with no overhead resistance until the 1980 high at $49.45. No, that's lower than the 2011 high. Let me correct. The 1980 high was approximately $50 on an intraday basis. The 2011 high was approximately $49 on an intraday basis. Above $50, there is no historical resistance. Silver would be trading at prices never seen in modern markets. The chart would provide no guidance. price would be set purely by the supply-demand dynamics of a crisis market. Here's my closing framework for the next 66 hours. Watch the news flow. Any report of Iranian military movement, proxy attacks, or U.S. force positioning will move weekend OTC prices and set expectations for Sunday's open. Watch for diplomatic signals. Any statement suggesting communication between Washington and Tehran will be read as de-escalation and will moderate price expectations. Watch for escalation signals. Any attack on U.S. assets, any closure of shipping lanes, any Israeli involvement will accelerate the move into scenarios 2 and 3. Most importantly, don't wait for certainty. Certainty arrives after prices have moved. If you wait until you know the outcome, you'll be buying at prices that already reflect that outcome. The opportunity is in the uncertainty. The opportunity is now. I've given you 3 scenarios with specific probabilities and specific price targets. Scenario 1, de-escalation, gold, $2,870, silver $35, probability 25%. Scenario 2, asymmetric retaliation, gold $3,025, silver $39, probability 55%. Scenario 3, direct war, gold $3,400, silver $50, probability 20%. Expected values, gold $3,061, silver $40.60. I've told you what I'm doing, buying physical silver aggressively, positioning for mining stock pullbacks, and preparing for contingencies. The information is now in your hands. What you do with it is your decision. A U.S. submarine just sank an Iranian ship. 66 hours until markets reopen. The world is holding its breath. The prices you see on your screen right now are the last prices from the old world. Monday's prices will reflect the new one. Make sure you're positioned for what's coming. This is JonCashFlow. A U.S. sub just sank an Iranian ship. Gold and silver are about to reprice. I've given you the scenarios, the targets, and the timeline. Now it's time to act. I'll see you on the other side.